For us, the first and key part of our investment process is really determining quality, and that's something that's been in place since 2007. What does determining quality mean? The number one swing factor there is, does this business have what we call an economic moat? The Buffettism there. Does this business have a sustainable competitive advantage that it can then exploit to continue to generate strong returns on capital for the foreseeable future? And that in and of itself is sort of what we would regard as a sort of an elite group of companies. Not all businesses have those natural protections around them, and they're things like having a really strong brand, that can't be replicated. It can be things like having a network effect, where there's a two-sided market where the number of participants supports the number of users. Think of a Visa card. If all the merchants around you didn't accept a Visa card, the incentive for you to have a Visa card wouldn't be there. And similarly, if all of the customers didn't have a Visa card, there'd be no incentive for the merchants to accept a Visa card. So it's interesting that those two sides of the market creates an incredibly strong network. That's very hard to disrupt. You could have economies of scale, be bigger than everyone else. It could be really hard to switch out of using your product or service. So those types of things can really be the cornerstone, or a combination of those even, as to what makes for a strong business that can last the test of time. So that's really the first thing. We also look at business risks. How predictable is the business, over a medium to long-term time period? That's important to us. We look at agency risk, which is, are management good stewards of shareholder capital? What's their acquisition strategy? Do they return cash to shareholders? What are they doing with that money that they generate? And of course, the other piece is reinvestment potential, which is, does the business have an opportunity to reinvest capital in its own business at high rates of return? The ideal scenario is a business that doesn't actually need much capital, incremental capital, to grow. And that obviously, is very appealing as well. But equally, a business that can deploy capital at decent rates of return is also very valuable. The next important step after that is what out of these businesses is actually trading at a reasonable price. If we think of our, main global portfolios, they're 20 to 25 stock portfolios. So each stock that is in that portfolio has to earn its place. And there's sort of this analogy that we tend to use of it being like a cricket team or a football team. Every player has a role, and every player has to earn their place over and above all the other people that would really love to be on the team as well. So, you might have, a defensive player that's there to sort of, keep everything together. You might have an aggressive player, the offensive side, that's there to, score all the goals or to hit all the sixes using the cricketing analogy. So each business really has to earn its place on the basis of its quality, but also on the basis of its value.